Welcome to BWC News. I am Elizabeth. How much trouble is the U.S. debt in right now? U.S. Treasury Secretary Yellen recently warned once again that the Treasury's cash will all run out as soon as June 1st, and that the U.S. now needs to compromise with all parties, and that resolving the U.S. debt crisis is an immediate priority. By various parties, she may have included China. But it is clear that China is not willing to make compromises at this point. Back in early April, the U.S. Treasury Department had already listed a bunch of data to the public, and finally told everyone that the Treasury had only slightly more than $110 billion in funds left, which was already a 15-month low at that time. To deal with the serial bank failures in the U.S. Treasury has spent more money than usual, down $28 billion in a week at the beginning of April, and now a month has passed, and if the money is spent at this rate, the U.S. Treasury should have run out of money by now. However, from Yellen's statement, we see that the Treasury now has some cash on hand, but it is only expected to support this month. As the available balance of cash raised by the U.S. Treasury through debt issuance is infinitely close to depletion, derivatives trading known as credit default swaps is heating up in the U.S., and the amount of bets linked to these contracts has grown about 8 times since the beginning of this year. That is, if the U.S. government fails to make payments to creditors on time, these contracts will bring lucrative gains to these speculators. Wall Street Goldman Sachs recently said that the United States hit the key debt ceiling deadline maybe earlier than the market generally expected. Goldman Sachs expects weak tax revenues or will make the U.S. government on the fast track to default on financial debt. Goldman Sachs' team of economists recently said that although preliminary statistics reveal limited information, but the weak taxes so far in April indicate that the possibility of reaching the U.S. debt ceiling in the first half of June has increased significantly. This is not the first outbreak of a mini-mania wave around this derivatives trade. There have been similar events back in 2011 and 2013, and also in 2021. But this time, everything feels a little different. For one thing, it's more likely that the government will default on its payments. After all, the bipartisan polarization in Washington is now so extreme that there's no guarantee that Republicans and Democrats will be able to reach a deal to raise the debt ceiling in time and avoid a default crisis. For speculators who are betting on a U.S. government default, a U.S. debt default could mean big returns for them, and the trading rules of the CDS derivatives market mean that if the U.S. government does default, speculators can take advantage of the lowest prices for long-term U.S. bonds to squeeze profits out of these contracts. According to agency calculations, some U.S. Treasuries have recently traded at less than 60% of face value, the result of a series of rapid interest rate hikes by the Federal Reserve, which, according to derivatives leverage, also means that the potential return could be more than 2,400%. Some data shows that these investors took the opportunity to buy these longer-term U.S. Treasuries trading at less than 60 cents on the dollar, and the potential return on a U.S. debt default bet via CDS would be more than 2,400%, meaning a return of more than $400,000. In addition to the profit potential, the rising cost of CDS insurance underscores Wall Street's anxiety over the pending U.S. debt ceiling. Recently, the White House issued a statement saying that if a U.S. debt default evolves into a long-term problem, it will have a serious impact on the U.S. economy and hurt taxpayers. It is expected that if the government is unable to resolve the debt problem and prevent it from becoming long-term within 3 months, the U.S. could see an economic disaster like the Great Depression. In such a scenario, 8.3 million people could lose their jobs and the stock market could plunge 45%, triggering a huge recession. Therefore, the U.S. needs to take measures to solve the debt problem. Currently, the U.S. is studying the possible long-term effects of a U.S. debt default, rather than the question of whether the U.S. debt will default. As the U.S. debt is about to exceed the debt ceiling, the U.S. government has not yet been able to raise the debt ceiling, which could lead to a default on U.S. debt. However, it will be difficult for the Federal Reserve to borrow any more money. First, as inflation has reached unbearable levels, if it continues to print dollars and borrow, it will further worsen the price problem. Second, the bottom of the United States may break out $0 purchase, leading to social unrest. Therefore, it is difficult for the government to reach an agreement on raising the debt ceiling. On the other hand, the debt ratio of the Federal Reserve has already exceeded the international alert line and is in a state of bankruptcy. However, the US government cannot allow the Fed to openly collapse, so it will take measures and laws to maintain its operations. However, as the US debt problem is difficult to solve, if there is really a US debt default, the US dollar will completely lose trust and the dollar hegemony will be gone. In this case, the Federal Reserve will face a huge dilemma. Economic disaster will come, but now the United States is nearly 190 banks are on the verge of bankruptcy, a large number of depositors are taking their money away. And what the US government can do is just keep digging out some money from the bigger banks, to fill the holes in the small and medium-sized banks. But in reality they've put off the problem again, but it's not expected that they'll last much longer. If the future of the US debt default, this will probably become the US economy as well as the Federal Reserve US credit a series of explosive lightning, when the whole United States will be a variety of collapse of the tragic situation. In this case, not long ago, the United States sighed in the mouth to China to soften, hoping to start a fair and healthy economic competition and cooperation with China. But this obviously looks perfunctory, because the US has only good words. He did not do that in practice. There is no end to his crackdown on China and its sanctions, and several major US arms dealers are still studying arms sales to Taiwan. And it is understood that the United States is preparing a series of measures against China in the future. So not only can China not listen to the sweet words of the United States at this time, but it must insist on doing the right thing, reducing its US debt holdings as much as possible. If the US gets further hysterical about China, then China could also be liquidating its short position in US debt, zeroing out US debt and also shipping back gold. China's central bank bought 8 tons of gold in March, according to the latest data released by the bank on May 7th. This is the 6th consecutive month of gold reserve holdings since last November, and a total increase of 128 tons during this period. In the first 4 months of the year, China's gold reserves increased by 66 tons, bringing the total to 2,076 tons. Previously, China's gold reserves had remained at 1,948 tons for 38 consecutive months. The move suggests that China is gradually disclosing its plans to increase its gold reserves in order to reduce its exposure to US Treasuries. But that's not all. Switzerland shipped up to 230 tons of gold to China in the first 3 months of the year, up 72% from the same period last year and the highest since 2018, according to a Swiss customs report released April 26. The data also showed that China's gold purchases from Switzerland, the world's main gold refining hub, have suddenly risen in recent months to the highest level in more than 5 years, with 1,417 tons of gold having arrived from Switzerland since 2020, and 524, 354 and 309 tons from 2022 to 2020, respectively. This trend exceeds market expectations. What do you have to say about this? Feel free to leave your opinion in the comments section.